The US dollar has remained strong in recent years, supported by high interest rates, Fed tightening, and safe haven demand. However, with these tailwinds fading, analysts expect a gradual weakening, not a collapse, in the coming years. While the dollar's dominance will likely continue, structural factors like fiscal deficits and global diversification efforts are set to weigh on its strengths over the long term. Well, to talk through this and more, I'm joined by Director of Global Macro, Vincent Deluard. Thank you for joining me.
Pleasure to be here.
So what's the long-term outlook for the US dollar in your view?
Well, so let's start with maybe what happened this year, which is truly an unprecedented decline in the dollar. I think we have the worst start of the year for the dollar since we were not the gold standard under Nixon, down 10% against major currencies. If you look at total carry return, underperforming major emerging market currencies as well. And that is unprecedented. And the other part that is unprecedented about this decline is the way in which it happened. So we used to have a pattern where the dollar would rally when stocks would go down. And generally speaking, the dollar was kind of a on risk-off asset. Treasuries would rally when stocks go down, dollar would rally. And we have seen the opposite, which I think changes the way foreign investors think about the dollar, the role in its portfolio, and would support the kind of long-term bearish view which I happen to share.
And what are the main factors that could drive the dollar's fluctuations over the long run, do you think?
So, when you look at currencies, you have to look, really, you have two main drivers of their long-term performance. One is interest rate differentials. So all else equal, you want to be capital wants to go where it's treated best. So if you have higher interest rates in the rest of the world, you should, all else equal, attract capital. The second one is purchasing power. Obviously, if your currency buys less goods and services than another currency, you will prefer that other currency. Generally, people say that the market trade on interest rate differential because short-term movements of capital are determined by these differences, but over the long term, purchasing power dominates. Now, when it comes to the dollar, I would argue that both these factors are no longer supportive. As you mentioned in the introduction, the dollar benefited from a very positive rate differential. The Fed hiked very aggressively. We'll remember Powell's, sequence of 75 basis point increases in the Fed funds rate, faster than the European Central Bank, much faster than the Bank of Japan. So the dollar had this huge carry advantage that is narrowing. The Fed will likely cut by 25 basis points. People think even 50 is a possibility in September. I don't, but whatever. The point is the Fed is going to cut quite aggressively. I personally believe it's a mistake. We still have core inflation at 3.1%, but the Fed's going to do it anyway. So the Fed is cutting rates at the same time. The ECB is pretty much happy where it is. The Bank of Japan keeps talking about hiking rates. And then in the emerging world, if you look at places like Brazil, like Mexico, have very high real rates. So in other words, the rate differential that used to be very supportive of the dollar is much less supportive. And then more importantly, for the very long term, is this purchasing power. And I mean, you see it, in the revolt of Europeans against Americans, tourists, taking picture and treating European culture as the background for an Instagram story. I mean, there's a reason why, American tourists are able to afford like cheap vacations in Europe. It's because the dollar is extremely overvalued. I mean, life in, especially in the major cities, you look in New York, San Francisco, LA, it's extraordinarily expensive compared to the rest of the world as well. So that would argue for, a weakening of the dollar, which you also see on the trade side. I mean, if your currency is massively overvalued, by definition, you're going to start to accumulate trade deficit because it's cheaper to produce abroad than it is domestically. And that comes with political consequences, some of which we're dealing with today.
And could the US dollar lose its safe haven status in the future?
I mean, if we leave it as in the future, I'll say yes. I mean, in the future, in the long term, we're all dead, like Keynes said. There has been reserve currencies before the Portuguese escudo, the Spanish peseta, the Napoleon franc, the British pound, the Genovese. I even forget what the currency of Genoa was. But yeah, there is a long graveyard of currencies that were once the global benchmark and the reserve currency for the world. And as the fate of nations roll over, that has rolled over. Now, the question is this an imminent risk for the dollar? Um, I mean, probably not. At the end of the day, it is still the most liquid. It's still the military hegemon. But on the margin, I would stress two reasons that would reduce the demand for dollar as a reserve asset. One is what's happening in the currency in the commodity market. So one of the major reasons for the dollar's rise as the global reserve currency is the fact that it's the currency that's used to invoice commodity trade. So if you're going to need to buy oil or natural gas or copper or silver, you're going to need to get dollar first. And that's been pretty much the case since the dollar overtook the pound, and we had this kind of agreement, handshake between the King of Saudi Arabia and I think it was President Roosevelt back then. That is eroding a little bit. We see more and more countries, especially China, but also India now, being able to settle some of the commodity trade in their own currencies. So all else equal, that means they need fewer dollars. So that reduces the demand for dollars. The second factor is what I was hinting in your first question, which is the behavior of the dollar. When the dollar behaves as a risk-off asset, meaning that you can reliably count on the fact that the value of your dollar is going to go up when bad things happen, you should want some of the dollar, regardless of its value, regardless of interest rate, because it acts a little bit like a put option that protects your portfolio in case of turbulences. Unfortunately, that hasn't been the case this year, and yeah, if you lose that kind of implied put in the dollar, then you start paying attention to the other factors, the ones I were mentioning, which was interest rate differential and purchasing power, and all else equal, that should reduce the demand for dollar. So certainly not a overnight loss of reserve currency status, but it's possible that over time we are seeing that share of dollar being slowly eroded.
And what scenarios could lead to a stronger or weaker dollar in the next decade, do you see?
Um, so I mean, there are many scenarios on both cases, so maybe I'll focus on the most likely. Um, on the strong dollar case, I think it's all about growth, and if we see American growth really take off, obviously so far the AI phenomenon is primarily a U.S. phenomenon, although I would argue that China is very close behind. So if we see this kind of transformative AGI, this massive investment in the U.S., rapid rise of productivity, kind of what we had in the 90s when we had the internet bubble start in the US, the dollar was very strong throughout the decade. So we could see maybe a repeat of that. I would say, yeah, the fate is the dollar is quite tied to the outlook for AI. If it's a bubble, the dollar will most likely weaken. If, on the other hand, we can see a sustained increase in the trend growth of the the US will keep attracting capital and outgrowing other economies. Another scenario where it could get stronger is if we see a worsening of international relation, even maybe escalation toward military conflicts. Obviously, the US in that case, is still so far the currency that backs the strongest army in the world. So in times of stress, it should do better. These would be the two main scenarios. I On the other side, scenarios that could lead to a weaker dollar would be, I think, a continuation of the current policies, where it's been kind of an article of faith that the U.S. wanted a strong dollar. The Treasury always starts, whenever there's a new Treasury Secretary, starts his administration by kind of reassuring the world. We believe in a strong dollar. A strong dollar is good for the U.S., good for the rest of the world. The reason every U.S. Treasury Secretary does that is because they want foreign central banks to keep their reserves into U.S. dollars. Now we have a different administration where I don't think that is the goal. On the other hand, the goal may be to weaken the dollar. there has been this reckoning that the strong dollar has led to the hollowing of the US manufacturing base, the hollowing of its middle class, and that if we want to reindustrialize the US, we're going to need a much weaker currency to do so. So when the the Treasury doesn't want a stronger dollar, the Fed theoretically is not involved in the dollar, right? The traditional is that the dollar policy depends from Treasury and the Fed sets the interest rate. But to the extent that the Fed obviously is relevant to the dollar, now we are seeing that the Fed is cutting interest rates when we have inflation about 3%. We are seeing a lot of pressure on the political independence of the Fed. So that also points to a weaker dollar.
Well, thank you very much for your analysis once again, Vincent. For more videos like this, please do like and subscribe.